All right, hello everyone. Welcome to our Composer webinar on modern fund ops, how to start and scale your own fund. I'm Michael, a product marketing manager here at Composer, and I'll be your host for today's session. We're excited to have Kevin joining us. Kevin is the CEO and co-founder of Repool, an end-to-end fund launch and administration platform purpose-built for modern hedge funds and emerging institutional managers. Kevin, welcome.
Thanks, Michael. Good to be here.
Awesome. To kick things off, could you share a little bit about your background and what led you to start Repool?
Yeah, absolutely. So, hey, everyone. Thanks for joining today. Like Michael said, I'm the founder and CEO here at Repool. So, the background for Repool is really grounded in kind of observing that this product essentially already exists for venture funds. So, for some of you who may be familiar, for a couple of years now, there have been these kind of tech first, venture fund in a box or SPV in a box type of products. But nothing like that really has ever existed historically for hedge funds. There have been a couple of vendors in the past who have claimed to do, easy fund launch, end-to-end fund launch, fund in a box, etc. But they've always just been actually like a middleman aggregator that takes a cut off the top of introducing to what is underneath just a bunch of counterparties. So that was really the opportunity that we saw. And in interviewing a lot of hedge fund managers, we really identified that the pains that these venture fund in a box products solve also applied to hedge fund managers, meaning your core competency is the execution of your trading strategy and not at all the operations, back office, and assembly of the vehicle. And it's an industry where there's a lot of lack of opacity, right? It's not very obvious how to start a fund. Frankly, different lawyers will give different advice. There are a lot of, let's say, lawyers who maybe overstep their actual expertise, whether it be providing advice on a state that they don't have expertise in, being focused on registered investment advisors instead of exempt reporting advisors. And so there's just this huge spread of difficulty and lack of kind of knowledge around how to actually get up and running. But in truth, for an emerging manager, it oftentimes can be surprisingly straightforward to get a fund up and running. And we can also lower the cost of entry, which allows for smaller funds to get a track record moving more quickly. So those were kind of the key factors that I think we really tuned in on. And my background is largely from the technology side. So the thesis for Repool was to essentially build an early stage team of tech operators who could build a platform that would automate and streamline a lot of the operations of a fund, and then combine that with folks who have deep expertise in fund administration from the existing industry.
Interesting. Yeah, thanks for that, Kevin. And just ahead of today's session, we've received a lot of great questions from the community. So I'll just give a quick overview of what we will be covering today. So first off, we'll be covering how to form your own fund and picking the right structure. Then we'll look at some of the common mistakes and misconceptions people might have during this process. Thirdly, we'll touch on like the legal, regulatory, and compliance basics, and then some key fund operations, what to expect as you grow, and lastly, some global and advanced scenarios for non-US and maybe some digital native funds. And then we'll go into live Q&A to wrap things up. Um, awesome. I mean, that sounds like a lot, so let's jump straight in. So let's start with the fund formation basics. Let's start with the foundation on how to get your fund off the ground. What are the key steps, would you say, to starting your own fund in 2025?
Yeah, I mean, it's a big question certainly, but I think there are a couple, two or three key things that come to mind. So what's interesting, I think, for a lot of folks, maybe to start from a regulatory perspective, the first question is, can I start a fund? Do I need licensure? Is it legal and so forth? And the interesting answer for a lot of folks is, in most cases, you probably can start a fund without actually being licensed as a registered investment advisor, meaning you probably don't need to have a series exam license. There's nothing you need to file. It's all actually going to be what's called a self-executing set of exemptions, meaning that if you do it right, it just kind of de facto true. So basically, there's this framework called being an exempt reporting advisor, or ERA, or in some states, you're an excluded advisor, meaning you're excluded from being considered an investment advisor if you exclusively advise private funds and you have less than a certain amount of private funds and you have less than 150 million in assets under management total across all of your activity. And so for most people who are just looking to start a first time, single or double digit emerging fund, that's actually the case. Now, there are a handful of states where no such exemption exists, but, without going into every single state, the good news is that most states, and especially the popular ones, i.e., New York, Florida, California, Texas, Connecticut, actually do have exemption frameworks. So, first things first, in short, a lot of people actually can, from a strictly licensure and regulatory perspective, technically get started. So, with that out of the way, I think the big items are really just honesty around two things: your capacity for your strategy and also your actual fundraise. I think the biggest thing that we've seen at Repool, and for some context for the audience, we have non-traditional fund managers, which is to say we have a bunch of clients who come from retail, essentially. They're from technology or whatever it may be. One of our really successful fund managers, actually, who has a couple dozen million, comes from construction. And so it's quite interesting. But we also have very institutional managers, right? So we have folks who are leaving desks at established shops, brand name shops, who have been at family offices. We have RIAs who have come on. A recent client of ours is a $2 billion RIA launching their first fund. So we see the spread. The biggest challenge for these kind of non-traditional managers and even some of the more institutional folks is overestimating how much they're going to raise. And then they spend a bunch of money. You kind of start the fund, you own these entities, you've done these filings with regulators, and then you raise, 20% of what you said you were going to raise. And now you're in a kind of bad spot, right? Because the economics are poor. So it's kind of odd advice because everyone who thinks they're going to launch a fund is very certain of how much capital they have. But the first piece of advice I give is to really, really, really firm up your capital commitments and make it almost like the fund already exists. When I talk to people, a lot of folks say things like, I've had these great conversations, these people are in, I'm going to raise, X amount, like 10 million, right? And then when we press in, we ask, okay, well, have you gotten them to sign letters of intent? Are you 100% sure the money's going to come in? What did that conversation actually look like? It's a lot softer than what I actually see being successful in practice. And then you have this massive shrinkage and this big delta between what you actually launch with and what you thought you would. So I would really advise people to almost behave as if the fund exists and go to people and say, okay, like, are you willing to, handshake on a deal? If I send an email saying you're in for $500,000, 100,000, will you confirm, yes, you're in on this date? Or even like some, letter of intent. It doesn't really, have any legal standing or anything. But the point is, there's no reason you should be uncomfortable about asking for the money now. And if you are, then that's a red flag, right? And so that's one, really encourage you to have a good sense of how much you need to start operating and that the money is real. The other is just capacity. I think, the other issue we've seen is people have been running these strategies. They've been back testing them. Maybe they're using Composer, but they're not actually robustly testing if their strategy scales to 20 million, but they're running it with 2 million, right? And I think that's something that institutional folks understand really well. Institutional allocators are often asking when they evaluate a potential fund is, how do I know your strategy actually scales? It's much easier to find alpha with a small pool of capital than a large pool of capital. And that can be true when we're talking about going from 50 million to 500 million or, billions, but it's also true just running from, 1 to 20 million. And so I think really making sure that you have a strong handle on the capacity of the strategy. And, the answer is never, it's exactly the same forever. There's nothing to think about, right? There's always going to be differences as you scale up with things like execution, with pricing, spreads, and also just, depending on the strategy, just the availability of alpha generally. So I think those three components, right? One, you can probably actually regulatorily start a fund, and that's where a lot of people get hung up. That's actually very rarely the issue. It's mostly just that fundraise and that capacity.
Got it. Really appreciate those that advice there. And maybe just going off of that question, and somebody was asking in the chat too, like, is it possible to start a fund with little to like no capital? And specifically, there was somebody, a registrant that asked, is there an ideal AUM to even begin with, especially if you're going for something like a long only fund?
Yeah. So look, I think there's two competing factors here, right? So, one is getting a track record moving in a true pooled capital vehicle is very useful. So I think there is some incentive to start with a small pool of capital. Meaning, I think a lot of people say things like, oh, I've got this great track record. It's my personal account. I'm going to, go take that to market. One, there's a lot of rules around marketing, right? So the SEC specifically has what are called marketing rules and then also pre-marketing rules. Some clever folks we talk to say, well, the fund doesn't exist yet. So like, I don't have to follow the rules. And, that's unfortunately not the case. There are pre-marketing rules as well, which essentially operate as if the fund does exist. And it can actually be very challenging to market a personal track record from like a literal legal standpoint. A lot of things need to be true in order for it to be marketable. So it's actually the case that most folks are not going to be able to market their track record from a personal account or a past life on a specific basis. This is even a problem for institutional folks, right? Usually if you leave a desk at, say, some quant shop or Millennium, you don't actually own your track record. So allocators want to see an actual track record. And so there's a little bit of a chicken and egg. So I do think if you are comfortable and okay with the economics, starting a small vehicle just to actually get a true track record in a pooled capital vehicle with true expenses on an institutional prime is going to be much better than running the strategy in a PA from a strictly fundraising standpoint. That said, I do think depending on the state, and I'll explain that in a second, you definitely want to have at least, I would say, 2 million on the shallow end to ideally, 5 million plus. If you're just trying to build a track record, maybe you can do with like a mil or so, but we'll talk about the expenses today and we'll kind of start to see why that can be quite painful. There are basically two broad categories of states from a regulatory perspective. Stepping back to what I had said earlier about being an exempt advisor, in some states you can be exempt and there is no requirement to receive an audit. And then in other states, and more commonly, there is a requirement to have your fund audited. So it doesn't matter what the size of the vehicle is. In most states, for most emerging managers, you will have to receive an annual audit. The reason I bring that up is it's just cost, right? So, roughly speaking, between launch, admin, audit, tax, compliance, you probably will carry a cost burden, and regulatory filing fees, which we can talk about too, of at the low end, 50 to 60K, okay? If you don't need to get an audit, that might be more like 30 to 40K. So that is a big difference, right? If you're $1 million vehicle, we're talking about 3 to 4% versus 7 to 8%. I think in candor, not a lot of people are going to find success if they're bearing 8% of the fund as an expense. You could choose not to pass that to the fund, in which case it wouldn't drag on your performance, but then you have to be willing to personally pay for it and have that be the cost of, embarking on this journey and trying to build a track record. And if you're not comfortable doing that, then, this is not going to be a very long-lived fund. So maybe to sum it up, we certainly have seen quite a few folks launch with less than $2 million, but they're kind of on a timeline window, right? Where if they don't have good results in their first 12 months and they can't raise shortly thereafter over their first 12 to 24 months, then you're kind of running in the red and the fund is not likely to live for much longer. If you know that, you're okay with that. That's just the cost of doing business. You want the opportunity. You're okay losing potentially some money to facilitate that. Then great. I think the worst situation is folks who, come in, underestimate, the challenges of raising, are really confident they're going to get to X amount of capital, drastically undershoot it, and then they didn't prepare for the economic, implications of running $1 million vehicle.
Got it. That makes sense. And with regards to, and somebody was asking this in the chat as well, but what would be the best path if somebody was launching like a friends and family fund? Do you have any thoughts on that?
Yeah, so this idea of a friends and family fund is interesting. Just for clarity, that's not like a regulatory term. We actually have a product at Repool we call a friends and family fund. That's just kind of a term
Right.
of art. That's just to say, you're basically not charging fees is kind of what I think of. It's like a true incubator fund, right? So you can certainly get away with a lesser structure there for a couple of reasons. One, we'll charge less, and I think a lot of admins will charge less for small funds. You can get away with probably less thorough docs, although I'm not necessarily going to prescribe that, but in theory, I guess your risk is lower. And then if you're not charging fees of any kind, you're not actually considered an investment advisor, which means that you don't have to do certain filings. You're not going to have that audit requirement no matter what state you're in. And all of that is to say, ultimately, it's reducing your cost structure, your expense ratio, making a smaller fund viable. So I think it's a good option, again, if you want to start building that track record. But it's not necessarily like some magic bullet that dramatically changes things, right? You still, at the end of the day, have a hedge fund. It's just that from an advisory perspective, you're not charging fees, and that means that you can bear a certain amount of lesser costs. Ethan asked a good question. I'll take it right now. So Ethan asked, is the state that affects regulatory implications based on the state that the company is registered in or the physical location of the fund manager? This is a common question. And the answer is it's the latter. It's where you're physically based. I'll draw a quick analogy that's hopefully understandable, right? Like most companies are formed in Delaware. Most hedge funds are also formed in Delaware. But like general companies, right, you follow the laws of the state that you actually do business in, right? So Repool is a New York-based company. I can't just say, hey, I formed in Texas, now I don't pay, income tax, right? That would be great. But from like a reductive first principles standpoint, if it were true that you could essentially just arbitrarily claim a state that's not your own, then no one would ever form hedge funds in quote unquote bad states. It is going to be the state that you are physically based in. In fact, if you have multiple managers, technically multiple states will claim provenance concurrently. So, the good news is that doesn't generally mean there's too much of a change because most states have a similar framework. It's not like, state A has like A, B, and C, and state B has, D, E, and F, and now we've got just twice the amount of things we're doing. But you do actually have to abide by the physical presence of all investment advisors when it comes to contemplating regulatory implications for the advisor. And I'll give an extreme example. You could be a US based manager advising, let's say, a Singaporean vehicle or a BVI vehicle with only foreign investors. Guess what? You're still subject to US law around investment advice because you're here and you're putting investment advice. You wouldn't be subject to certain things around the fund because the fund is not in the US, but there are multiple regulatory frameworks applying. And in short, again, indeed, your physical location is always going to be quite important. And to claim a physical place of business, you can't just get like some virtual address. You need to actually have a reasonable claim that that's the location you principally conduct business from. So another example, we'll see people like, well, I own a vacation home in Florida, but I'm based in, whatever state. Can I just say Florida? This is, you could try. I'm not going to prescribe that. I think depending on the posture of your state regulators, if they find out, they may not like that, and you may get in quite a bit of trouble, right? And so that would be considered a very aggressive regulatory stance to take to just claim, frankly, a fictional place of business. And certainly we are not very comfortable when we try and see folks. We see folks try and do that. Sorry, that was a bit of a diversion. Michael, back to you.
No, not at all, not at all. That's great. Yeah, I think really appreciate all of you guys in the chat seeing those questions. We'll try to get to as many as we can, but we do also want to be mindful of time here. Let's just answer one more here from Petros in the chat here. So he asked, so the 50 to 60K is a startup cost, correct? And how about any monthly fees?
Yeah, so no, that's kind of like all in. I mean, look, much like anything, right? That's kind of like your low end case, right? Like, a huge institutional fund coming out the door with 250K is going to blow more than 200K on just the fund launch itself, just the docs, right? But that's just to say, depends on the quality of your launch provider, it depends on, the reputation of your admin, it depends on the reputation of your auditor, right? Are you getting an audit from KPMG or a local shop? But of course, for most emerging managers, we're generally seeing people who are cost conscious going for kind of the lowest but acceptable quality provider. So that is generally, I think, what you would expect to pay over the course of the first year. I'll give an example with Repool for a standard fund, which let's not go into that now, but let's just say it's most funds that are doing relatively normal things. Our price year one is 30K upfront. And then, you got to add your audit. So that would be 15K. Let's call it 5 to 10K in regulatory filing fees and costs for states and the SEC. Could be less, could be more. Just depends on your circumstances, how many investors you have, where those investors are. You might have another 5 to 10K for things like compliance and tax, right? So that's how you might get to this like 60 to 70K number, right? And so, you will end up often paying a significant chunk of that up front, but you can also reimburse yourself for fund expenses. But if you do that, right, then that's going to come out of your P&L, right? So reductively speaking, almost anything that you spend on your fund launch and your operations, you have the right to structure your fund to say, hey, we're actually going to bill this to investors. But then if you do that, now you're just dragging your performance. So again, if you're billing 50K to $1 million fund, you're just dragging your performance down by 5%. And that's a lot, right? I think as funds scale, these costs are not linear, right? So a $20 million fund is not going to pay 50K a year. It's going to pay a bit more, but it's not going to pay 20X or even 10X or even 5X what a $1 million fund is. So that's what makes running a really small fund challenging. I think there are a lot of famous funds that started with very low amounts of capital out of some, door room. I think, Citadel or Millennium, one of the two might have been like that back in the 80s or such. But it's because the goals of that person were to build a track record and know that they might not make money. If you're kind of like, hey, I'm going to launch $1 million, $2 million, $3, $4 million vehicle, and this is going to be how I'm going to make my living, then I think you're kind of betting on like winning the lottery, right? That's like not where I would, rely on my life plans. I think your goal needs to be like, this is my starting point and I'm not going to lose too much money in the worst case, but this could be the beginning of a path to actually succeed and raise more capital and actually run a fund. And I think funds start to be a lot more shelf stable and maybe full-time looking in that 10 to $25 million range, because that at that point, your total cost of expenses that you bill to investors might only be 0.5, 0.6% or less. And then your management fee is enough to actually pay yourself like a livable salary and range. So I think maybe another way of putting it is if you're going to launch a sub $10 million vehicle, you really need to have the right expectations on what you're doing. This is not yet, how you're going to, bring bread home.
Got it. Got it. Makes sense. And we'll come back to the kind of like the Q&A in the chat here, but let's move on to the next section about common mistakes and misconceptions. Um, so let's talk about what not to do, right? So what are some of the most common mistakes or misconceptions that you see from first time fund managers?
I would say it's two things. One is don't think you're going to find some creative solution no one else has ever considered, and you big brain the law, to kind of use a term I like to use. Our goal as a company is to make this as easy as possible. And if there were easier ways to do it, we would love to do that. We would love to make it possible for 500K vehicles to exist, assuming, the person is competent and such. But, every once in a while I run into people who, they read the law on their own. They're not a lawyer. They spend 30 minutes and they think about it at night and they come back and they go, okay, what if I do this? Am I no longer considered a hedge fund? Or, I think now this law doesn't apply. And look, these laws have been around and evolving for over 100 years. And the biggest asset managers in the world, armed with the best lawyers in the world, have tried everything, all possible avenues to make everything as easy as possible. I assure you, you didn't figure out some, big brain SEC securities law loophole in, 2 hours on your couch at night, right? And so I think, not to say anyone on the live stream is doing that, but every once in a while we run into some very obstinate where they're like, I read the law and we don't think this is a hedge fund because like we did this creative thing where we are like backdooring fees, or we structured it not as an LLC or LP, therefore it's not a fund. It's a lot more like if it looks like a duck and it quacks like a duck, and the SEC is very spirit of the law oriented, and there's plenty of case law around it. So I would certainly say, like, look, accept the fact that if you're going to run external money, you either are going to run as an RIA and do wealth advisory and separately managed accounts, which requires licensure, and you're certainly not pulling the capital, and there's a bunch of, upsides and downsides to that, or you have a hedge fund, right? It doesn't really matter what you do. It doesn't really matter how much you structure it. From a just de facto perspective, if you pool money other than your own, you have a pooled capital vehicle. You're subject to the law. So that's one. Perhaps I think the other that's more material is just like a focus issue. It's not so much like a misconception. I just think a lot of people are just focused on the wrong things, and I think it's very natural to do this because you want to try and control what you can control. But a lot of people are obsessed with like the perfect operating stack, and they want to have this service provider doing this, and they want to have a website, and they want to have like all these extraneous things that matter, but they're like 5% of what matters, right? The number one things that matter are, can you raise money and can you run that money successfully? And I always get a little bit, I don't know, frustrated is a little strong, but I always just get a little dubious when people are really fixated on these things. Like no one's going to, let's say someone was going to cut $1 million check. They're not going to not cut the check because you don't have a nice website, or, you don't have, some certain name brand provider. It's, at the end of the day, are you good at running money, right? So don't make your life harder by focusing on the wrong things. Focus your energy on getting that capital, refining your strategy. I think those are the two primary items. Perhaps like some miscellaneous things that are important to note, that are not, a little indirect to your question, but I think are relevant. I don't think this affects composer folks, but if you're trading or investing in CFTC assets, meaning futures, forex, derivatives other than options, then that is a CFTC regime item, an NFA regime item, and that actually is very tricky. So in short, there's not really a great exemption framework for those types of assets, and it's going to be very challenging for anyone with less than, say, 20 million to operate as what's called a commodity pool. So that's very tough, right? So I think for most emerging managers, the candid reality is that if you don't think you can raise at least 10 million, ideally more, you're not going to be trading, at least in any significant degree whatsoever, anything other than securities and options, right? So that's still a wide range, right? That's equities, bonds, warrants, ETFs, but you're not going to move to like futures and forex. The other item is just being careful about offshore capital. You can raise offshore capital into a US fund, but there are a lot of regulatory implications there, and we don't need to go down a big sideline tangent about that now. But in short, I would be making my plans as an emerging manager based on US based capital for the most part. And I think the last one is and this actually is really important. I almost forgot. The investor qualifications to be allowed to invest in your fund. Okay. There is one common misconception here. Some of you listening may know there's something called 506B and C. These are what are called, the Securities Act private placements. Basically, when you bring on an investor, you are de facto selling a security. In this case, it's a interest in your fund. That's what's the security. It doesn't matter how you structure it again, right? Could be shares, could be just interest, could be whatever. But when you bring on an investor, you are literally selling someone a private security. So you need to follow the Securities Act. There is this act called this exemption called 506B, which says, hey, you can sell to accredited investors. And then it has some other rules. It says at one part that there's a certain way you might be able to take on non-accredited investors. Without making this webinar an hour-long diatribe about regulatory regimes, you cannot take on non-accredited investors. So that just doesn't work. There's a bunch of reasons for it. There's other parts of that law about the disclosures you need to give them. But also, that's not the only law that applies, is probably the short takeaway. Because of what we talked about earlier, there's like laws around the advisor. There's no state in which you're allowed to charge fees to a non-accredited investor. So, amongst other things, there's just zero world in which you're bringing on non-accredited investors. And I think most service providers are uncomfortable with it. For example, Repool, if you come to us and you just insist, you're like, look, it's my problem, I'm going to sell to non-accredited investors, we're just not going to work with you. Like, I don't want that risk. I don't want that problem. As far as I'm concerned, you're probably breaking the law. That's not great. But accredited alone may not be enough. In most states, actually, the requirement for an investor to be allowed to come into your fund is actually what's called a qualified client, not to be confused with another term called qualified purchaser. I know these names. I didn't come up with them. Qualified client means $2.2 million of net worth. Okay, so in many states, not all, in many states, like California and Texas, you will be restricted to accredited investors that are also qualified clients. So, I do talk to some folks where they think they're going to raise capital from a bunch of accredited investors, meaning they have 200K in income or $1 million in net worth, but they're not qualified clients. If that's the case, you are SOL, and that is based on where you are. Now, there are some states where the standard is just accredited. That would be states like Florida, North Carolina, New Jersey, and New York. But these are not really things that Repool controls, or it's not like you're going to talk to a different admin or a different lawyer and suddenly your situation's going to change. I think the practical output of this is it's pretty important as a general rule of thumb that your raise comes from qualified clients that will cover you in all circumstances. So I'll pause there. That was a very long answer.
No, that was great. Thanks so much for that. And actually going off of that, I think I do want to take a step back because I do see, Rob has a question about kind of like structuring the fund. So I do want to take a step back and talk a little bit about like what structures, whether it's like an LLC or a C Corp or a limited partnership, what kind of structure would make sense, most sense for a first-time manager. And specifically in Rob's question, he's asking, if I'm starting a company to build analytical apps for trading and also raising money for that, but I also want to start a hedge fund. Should they be separate LLCs? So if you don't mind just walking us through some of the structure.
Yeah. It's an interesting question. We run into this from time to time where people are building like a company and then the hedge fund is something on the side. I want to caveat before I jump in that, look, I'm not a lawyer. Repool is not lawyers. We do not give legal advice. So specifically what I'm not going to tell you is what is the right structure. But I can certainly tell you observationally and from our own understanding what I would expect. I've never seen a fund that's a corporation. I don't even know if that is or isn't possible. I certainly, if the goal of making it a corporation is to somehow change the law, I don't think that would matter for the reasons I described earlier about spirit of the law. Looks like a duck, quacks like a duck. Most hedge funds are either LLCs or LPs. So I don't really think it would make a ton of sense to make it a corporation. From like a startup perspective, because we ourselves are venture backed, similar to Composer and such. Like you can't just like raise venture money and then start trading, right? There are regulatory restrictions on the types of entities that may engage in trading. And, if generally speaking, if you're not actually a dedicated pooled capital vehicle and you invest your money into anything other than like treasuries in the bank account, you'll open yourselves up to fiduciary claims by, investors. There's a reason, these companies that are sitting on hundreds of millions of cash, they're not like, giving all that money to a hedge fund manager, right? So, I don't tend to see these things commingle. Like you either have a pooled capital vehicle, hedge fund, venture fund, PE fund, real estate fund, commingled fund, or you do not. And I don't think, I'm not aware of, I've never seen like a reason to, or any structure out in the wild where, there's this entity doing both things. So that's kind of point one. I guess to the just structuring generally, most hedge funds again are limited partnerships, and some are LLCs. I wouldn't really fixate too much on that because those are primarily just oriented around state tax considerations for emerging managers. There are some states in which it is tax advantage to have three entities, i.e., you have an LP fund, you have a GP that's an LLC, you have a manager entity. And there are some states where that tax benefit doesn't exist, so you could just get by having two LLCs. The LLC is a fund, the manager is an LLC as well, and then you just have one less entity, so you don't have to deal with the taxes and operations and administration and accounting of that third entity. Repool has a de facto view. If you come to us and you say I'm launching in New York, we just de facto assume it's a triple entity structure. So we have kind of like this is what Repool does for all 50 states. But again, I don't really think that's an area that the manager should be focusing because the benefit is relatively de minimis. And, at the end of the day, it's still trying to achieve the same purpose.
Got it. Got it. Um, okay, let's move on to the next section about legal licensing and compliance. Let's try to keep this one short, just to be wary of time. Uh, just maybe one question on this section. What licenses or registrations are needed to run a small hedge fund, like 5 million AUM with
Yep.
qualified investors and a performance fee?
Yeah. So we kind of touched on this earlier, right? But being a registered investment advisor doesn't is more of like a consideration around the size of your vehicles or what type of business activity you're doing. So this whole idea of being exempt is in most states just something for private fund advisors. So this is why you probably never run into the wild and seen like an exempt wealth advisor, right? Those guys are all RIAs. So generally speaking, again, there's 50 states, so we're not going to go to each one. Generally speaking, if you're engaging in anything other than advising private funds, in just a couple of them, like SMAs, wealth management, etc., you're probably going to have to be a registered investment advisor. From the fund perspective, what are the circumstances in which you need to be an RIA? The primary trigger is having more than $150 million in assets or being in one of those like 8 or 9-ish states that just don't have an exemption framework. I don't want to plug Repool too much, but I do think on our site we have a pretty good resource, which is a guide to all 50 states. If you go to our site and hit the resources and guides button, we have like a overview of every single state's exemption framework and what the investor restrictions are, whether it's accredited or qualified, and also the reporting requirements for things like audit and whether the exemption framework exists at all or not. But most managers are not going to need to be registered. So maybe the derivative question we get is like, is it beneficial to be registered? You know, I would say probably not. There's not like a now I'm registered and I can advise non-accredited investors or something. So I think that's the number one thing people come. They're like, hey, if I become registered, can I start taking on clients that I wouldn't be able to otherwise? And that is basically never the case. You're still going to be restricted. Actually, RIAs are specifically restricted to qualified clients. So in some states, if you become registered, you're actually increasing the investor standard on yourself. Like in New York, if you had to become registered, you would no longer be able to advise people who are just accredited and charge them performance fees in a pooled capital vehicle. It also significantly increases your reporting burden, right? Like when you're an RIA, you're going to increase your cost structure probably on the order of 15 to 50K a year because you're going to have to do RIA compliance, some of which is specific to your fund, but most of which is just general to being an RIA around record keeping, reporting, and compliance. And, it's very serious, right? The SEC and certain state regulators will check in. Certain states are, more scrutinous than others. We've had to talk to regulators because they've pinged us about our clients before as well. So it certainly is something where state regulators are watching and ensuring. So when you make yourself an RIA, you essentially increase your cost, you increase your compliance, and you put a microscope on yourself. That's not to say being exempt is a way to like avoid scrutiny, but I don't know of any reason why you would like go out of your way to be registered if you don't otherwise need to because you haven't exceeded 150 million AUM or you're not engaging in other wealth advisory activity.
Makes sense. Makes sense. Sweet. Let's move on to the next section about fund operations and scaling. So I think maybe just like a kickoff question on this section is, when once your fund is formed, what does the day-to-day look like for that, and how would you scale and how does kind of Repool fit into this?
Yeah, I mean, we haven't talked too much about Repool and specifically the services we provide, but think of it this way, right? When you start a hedge fund, you're really just starting a startup, you're starting a company. And like any company, you have a bunch of stuff that is not the stuff that you are actually trying to do, right? Like for Repool, I want to build a great fund launch and fund admin practice, but I have to deal with like HR and insurance and PEO and taxes and accounting. And so in tech, as I'm sure Composer does, you generally go and outsource all of those things. You hire vendors and service providers. Basically, what Repool does is the hedge fund equivalent of that, and hedge funds have specific areas they focus on that are different than quote unquote non-hedge fund companies. So the biggest one is fund administration. There's compliance and filings. There's investor relations, onboarding, KYC, and AML. There's kind of like money control and treasury function. Basically, the ideal case is whether you use Repool or not, you come up with a stack such that you don't have to do other things other than focus on raising and investing, right? Now, as your fund becomes bigger and so forth, like any business, your problems are going to increase, and you should expect that you're going to have to do more. But for a lot of very early stage managers, where it might just be one, two, three, four folks running the fund, they're exempt. They have a good set of service providers that have streamlined operations, like hopefully a Repool. Then you actually should not really have to do much other than trade and invest and manage your LPs, right? Everything else is going to be abstracted away by your service providers. So there's not this huge litany of things you need to do. Again, if you have to become registered and so forth, then compliance is probably the biggest thing that shifts up, and it's quite serious. I spend a lot of time with our RIA clients working on compliance related matters, and you'll often hire someone when you get to scale just to do compliance, just to do investor relations. But yeah, in short, not a lot really in an ideal case. Hopefully, other than the fundraising management, you can mostly just focus on your strategy.
Right. That's awesome. That's awesome. And when would you say like a trader should take that step into considering formalizing into a fund? From your experience, when do you see traders kind of consider that step?
I mean, I I think it depends a lot on your goals, right? I mean, I don't necessarily have like a, hey, now you've hit this threshold of trading experience and track record, therefore you should launch a fund, right? Launching a fund is not a trivial exercise. You're going to have to manage LPs. Your people are giving you their money. Everything is happy when the money goes up. Things are not very happy when the money goes down, and a lot of investors are going to behave very differently. Some of them are going to constantly be asking you for information, for updates. You know, you just need to be ready to deal with that, I guess. But I think the primary trigger is, do you think that your strategy scales in the upcoming market conditions that you predict? And then can you raise enough money for it to be worth the squeeze? For some folks, that's, hey, I want to do a part time fund at $3 million. For other folks, it's, I'm not going to do this unless I can raise 50 million at the least because I'm going to quit my job and this is going to be full time. So I really don't know that there's a formula. Perhaps what I would say on the counter, though, not to offend anyone or such, we talked to a lot of young folks, we talked to a lot of inexperienced traders. I would definitely be cautious if you've been trading 2, 3, 4 years and you've been doing great. You know, you could work out. We have some clients who have surprised, but a lot of times that is not actually as much experience as you might think, right? There's a reason when you look institutionally, the people who actually spin out of their funds and succeed, they're people with like 8+ years of experience, and that's in a very refined environment where they're receiving very professional training, have very professional infrastructure. It is hard to manage money, and you need to seriously contemplate not just the upside, which is cool and exciting, but you also need to ask, like, what's going to happen if I launch this thing and I lose a bunch of people's money, right? And I think a lot of people, like in most cases, just like building a company, you don't spend much time thinking about the unhappy case and seriously contemplating how you'll feel if you're there. And that does happen to people, right? So a little off course from your direct question, but I think it's just really being honest with yourself on what am I getting out of this? What are my goals? And am I prepared for both the upside and the downside case? And what's the conservative case? Is the conservative case, something I'm actually happy with?
Yeah, appreciate those insights there. That makes a lot of sense. And let's move on to like the last section before we can take a deeper dive into some of the questions in the chat. Uh, so this section is more about like kind of global or more advanced scenarios. So would you say that like from your experience, can Canadian citizens or international citizens launch US based funds and use repool services?
Yeah, that's a great question. We do see Canadians in particular. In short, You certainly can launch a US based fund as a foreign advisor, as the term would be. But the thing that you need to remember that we would not help with, and generally US providers, even if you're quote unquote launching a fund the traditional way, getting a lawyer and then separate counterparties for admin compliance, software, et cetera, and so forth. Um, just like the US and how I explained earlier, if you are running a US, based operation and you're advising someone, some fund, whether it's in the US or not, Canada's going to have laws on being an advisor in Canada. I couldn't tell you in any level of detail what they are, but I have clients who have done that, and I can tell you they're relatively onerous. I'm not aware of like these more generous exemptions the US has. So you can't, I guess maybe the takeaway is like, there are almost certainly going to be laws from your own country on being an investment advisor. In fact, I would be willing to bet a lot that there definitely is. And I would be curious if anyone reaches out and says, my country doesn't have any laws on providing investment advice. And that's something that you'll have to handle locally through your own counsel and such. So, yes, but also you're going to have to figure out your own country.
Um, Another question for this part is, if your AUM grows in your fund, like how should fund structure or like infrastructure involve? And I remember, Petros also asked the question in the chat beforehand about, if you kind of if you move forward into like year two, year three, year four into your fund, like does your fund structure and infrastructure involve?
Yeah, I mean, look, the strategy and the structure of the fund doesn't actually need to change in principle as the fund grows. There are plenty of large funds that have a very straightforward strategy, and they're still running largely the same stack that they were when they were 5 million as they are at 500. But there's no one right answer there, right? I mean, as alpha becomes harder to generate, you'll see things. One very common example is multi-priming. Most managers who are under 25 mil are going to start on interactive brokers or maybe a platform like emerging platform like a Composer or such. There's only kind of a couple platforms out there that are allowed and willing to take on subscale managers, Composer being one of them, and IBKR being, the market leader. So a lot of the quote unquote more institutional primes, Jeffries, Jones, BTIG, Merrick's, Clear Street, all of the bulge brackets, Goldman, JPM, whatever, you'll start to see managers switch to those primes in the 50 to 100 million range. It's also very common to multi-prime, meaning once you start, let's say you're running a long equity bias strategy, you're, at 50 million, you're putting on very large trades. To get best price and also to fulfill, you might get what's called an order management system or OMS to basically execute across multiple primes. So that is to say, like any business, yeah, as you scale, you're going to have to get more sophisticated infrastructure, and that's going to come with costs, and it often entails that you'll have to learn new things or perhaps get personnel. OMS and multi-priming is a very common one. Compliance is the other, right? If you have to become an RIA, it's a substantial difference in how you have to think about operations and being buttoned up and record keeping and so forth. Structurally, probably the biggest difference is if you decide that you need to start taking on international capital, in most cases, I would expect you to open a BVI or Cayman entity. Not to open that whole can of worms, but in general, again, while an investor can come into a US fund, there are reasons why that's undesirable for the investor, primarily around taxes. Not like you somehow, don't pay taxes if you're in Cayman or BVI. It's actually like now I have to file taxes in the US and I'm not a US person. That sucks. In the same way that if I showed up to you and I said, hey, Michael, here's a Spanish tax form, go file, you'd be like, I don't want to do that. Why? Yeah. Right? International LPs don't want to get a US tax ID. So they typically go into a taxless jurisdiction fund like BVI or Cayman, and they'll still pay tax, pay the same tax. It's just they don't have to file in Cayman. They'll just declare it as like income on their local tax form, which is the benefit. So in short, most funds that have international LPs are going to add an international feeder or master at some point. And that can be quite expensive. Now you have essentially 2-3 funds. So your compliance goes up, your admin goes up, et cetera. But those are probably the biggest levers. But in principle, again, like, none of these things necessarily need to happen. So the complexity of a large asset manager is correlatively likely to be more complex just because they're likely to be chasing new assets. They're likely to be doing more obscure things. They're likely to be multi-priming. They're likely to have international LPs. But on the other hand, I was talking to a $500 million manager literally yesterday. Is very institutional. Most folks are not going to have 500 mil out of the gate. But he's just launching a US only fund, trading long, right? So that is going to be a really easy fund, even though it's 500 million. And then there are going to be funds that are 50 million that are doing all sorts of stuff like trading Indian equities on an Indian exchange and having offshore investors. And they're going to have a much more complex set of operations than that big fund.
Interesting. Appreciate those insights again. That's very interesting. And I guess the last question on my side before we jump into the live Q&A is on the side of digital assets. And is it possible to set up a digital fund that invests in tokenized or asset-backed securities like real estate or digital assets?
I don't see a lot of like tokenized real estate, so I don't want to speak to that. My answer there is I'm pretty dubious that there's serious alpha to be returned at scale for those things. My understanding of the landscape is it's like pretty retail oriented with pretty de minimis returns. But certainly don't want to speak for managers who might think otherwise out there. As far as digital assets, certainly digital asset funds are booming. You saw a big wave of digital asset funds a couple years ago, then again more recently. In principle, most digital assets are handled like securities when you're considering them from a spot perspective, and then most derivatives like perps, futures, crypto options are considered CFTC. So, it is relatively trivial to start a spot digital asset fund. It is super not trivial to start anything other than a spot digital asset fund, and then also the more esoteric the assets, the more challenging it's going to be. It's pretty challenging from a regulatory perspective for counterparties like us, for your admin, for your auditor, for your tax to handle DeFi. Frankly, I think the legitimate institutional digital asset funds out there are generally not doing a ton of DeFi. Also, because usually those are people chasing extraordinarily speculatively, risky gains that are very volatile, don't have a lot of capacity. So I don't, personally love it when I see those because I'm very dubious that you can actually generate returns consistently for, a pool of capital chasing what, for lack of better coin, shit coins. But yeah, in principle, yeah, crypto and digital assets are a big space right now. I think that trend is likely to continue with regulatory clarity having come in the last years. The current administration, the new SEC chair indicating a lot of interest in becoming a more crypto-friendly jurisdiction. But at the end of the day, it is basically like a hedge fund. Like, maybe a quick misconception throwback question is sometimes we talk to people like, well, I'm treating digital assets, so I don't have any laws. And again, not very likely there's no laws. In fact, it's pretty well established how digital asset funds are treated, and it is basically like any other hedge fund, depending on, the assets being traded.
Got it. Makes sense. Thanks so much for that. And let's go straight into the live Q&A now. And um, feel free, if there's any questions um, that look like
Yeah, I mean, I think just thinking about the audience base, looking at some of the questions, right? I think at least a significant portion of the folks here are, I'm guessing, younger, maybe have less than 5 years of experience trading, et cetera. So I see that in some of these questions, like how many years of experience do we need to start a fund? How do you fundraise? I think the unsexy answer for these questions, and we hear this all the time from folks who reach out, right? Because we're generally happy to try and be helpful even when it's not a fit. Look, like it's not easy. You're not going to find some resource where suddenly you think you're good at trading and you find this vendor and they like hook you up with capital. I think the problems like how do I raise? There's no easy answer there, right? I know plenty of institutional folks who struggle to raise, right? And that, if there was some magic bullet out there, then everyone would be on it and then it would be gone. Just like, finding alpha, right? If everyone knows it, the alpha's competed away. I was at a major hedge fund conference and I met a guy who was a PM at Citadel. He only had $10 million, which for him was quite small. And he could not, for the life of him, raise money. And, you have to realize you're up against these people. So maybe the actual advice is you need to spend time actually trying to build relationships with people who could be investors, and you should get that practice. And you should also consider trying to find, unique sources of capital, right? If you go to New York and you chase institutional allocators, you're competing with everyone else who's doing that, which are some of the most sophisticated, best traders in the world. If you go to Texas and you raise from family offices who don't participate in the New York hedge fund community, you actually will often have better luck. So when I look at a lot of these retail-centric funds, in candor, I see it primarily as people raising from non-traditional allocators, meaning they're not raising from endowments, they're not raising from institutions, pensions, nonprofits, family offices in major cities, not other funds. They're raising from high net worth individuals in their locality. They're raising from small family offices that are more off the radar. They're raising from rich friends and family. That has pros and cons. The pros are you're not competing with anyone and it can be easier to raise. The cons are these people probably are not going to be how you get to be $100 million fund, right? So I think if you're sitting there going, I think I'm a great trader, I have no investors, what should I do? Unfortunately, the answer is like you need to go out there and start meeting people and making connections and learning how to leapfrog and network and pitch people. And there's no vendor out there. This is the number one question I get. Do you have cap intro? Is there a network of LPs? That's great. If it was out there, I'd be telling everyone because we want, selfishly, I want to see my clients grow. That's how we get paid more. But there's really no magic bullet out there, I guess. As far as trading experience, look, I think I've seen literally college kids come out and raise millions. And then I've seen people with 20 years of track record fail to raise. So it's an intersection of like all things, right? It's just kind of like starting a company and raising venture capital. There's not this like A plus B equals C thing here where you suddenly hit this magic threshold experience. How sophisticated are you at articulating your strategy? How thoroughly have you back tested the strategy? How, what's the sharp on the strategy? Can you speak to all the metrics around the strategy, its capacity? How does it scale? How does the strategy change and adjust over time? There are people who are trading their whole lives and couldn't tell you any of those things, and they're not going to succeed as fund managers. And then there are whiz kid college students who are extraordinarily sophisticated and built quantitative strategies, can tell you everything under the sun about what they're doing and why it's going to work. And so, look, like you've just got to know yourself and be honest. Are you sophisticated? Can you speak to these things? Can you convince people? That's really it.
Awesome. Let's take one more question from the audience here. So this was asked 2 times. So I think Somi asked, if so someone asked a question about track record and whether a platform like Darwin X Zero is good for to showcase track records.
So I'm not familiar with Darwin X Zero. Just googling it really quickly, it looks like they do track record certification. So probably, I think that generally you need to have an audited track record. So I'm pretty sure Darwin X is not an auditor. So there's always going to be costs, right? And I think as far as track record goes, the biggest things are as follows, right? One is you have to have a lot of disclosures around your track record, which is why it's hard for you to put it together yourself for it to be legal marketing material. Typically, you'd work with a lawyer or compliance firm to put that type of stuff together, disclosing around, this wasn't a pooled capital vehicle. Here are the differences. Here are the risks. Here are all the things you should think about that are different than if this was a true capital vehicle. The other is just whether or not that track record is actually portable or not. For a track record to be portable, it has to be into a pooled capital vehicle. It needs to be substantially the same strategy that is expected to be run in the actual pooled capital vehicle. And it has to be the same personnel. And that's where a lot of problems arise, right? Is like, sure, maybe you were trading and you had this track record, but now you're going to start a fund with your colleague or your friend. Now they're going to be involved in investment decision making. You can't take your strategy and they go, oh yeah, like this is my strategy, but now this other person is going to be involved in execution of the strategy, but like you should rely on when it was just me, right? You can see how that would be materially misleading and not a picture of the truth. And that's often the biggest barrier, right? Is like very rarely do people have these like shared track records with their colleagues that they're actually operating the fund collectively. So you can actually take that to market. And all of this is kind of maybe to say that like, it can be, yeah, it's challenging to take a PA and basically take it out to market, I guess. And I don't really know that there's like a amazing solve for it. Certainly track record validation platforms can help. But I would definitely be cautious about taking a personal track record out to market unless you've spoken with, compliance. We can talk about it in greater depth because we do compliance or a lawyer.
Got it. Yeah, I know, I do see a lot of different questions, a lot more questions in the chat here, but I think we're kind of running out of time. So, Kevin, if you don't mind actually just sharing like a link to whether it's signing up for Repool or booking a call with some guys on your team, I think it would be great for the chat here, so that they can, sign up afterwards if they're looking for
Yeah, of
help.
course. So a couple of things that I'll kind of plug. One, I think you hopefully have gotten the sense like even though it'd be good for our business to just take on anyone, we're actually very cautious about who we take on. I don't want to take on someone who's going to fail in their first 12 months. I don't want to take on someone who's going to lose a bunch of money. So we really, obviously, we're not too opinionated. Our job is not to like audit whether we think you're good, but we're certainly not here to just push everyone to start a fund. And I think that's part of what gives us credibility in the market. And so we're certainly happy to speak to anyone who thinks they have a serious shot at launching a vehicle. And so you can just reach out on the site repool.com and hit the contact button. It'll give a big intake form that helps us understand the shape of your fund and who you are. And we're always happy to take a look and give you an honest assessment of whether we think it makes sense to set up time. From a resourcing perspective, to learn about some of the regulatory investor restrictions, costs, I really mean it. I know a lot of websites just put out garbage content just to fill the content mill. We don't put out almost any content. What content we have, I think, is specifically to try and, frankly, avoid us having to have these conversations with people on the phone, because it's a lot of time. If you go to repool.com, you go to the resources and guide section, we talk about the three major acts that apply to hedge funds in articles that I personally wrote: the Investment Advisors Act, the Investment Company Act, the Securities Act. All three of those apply to every hedge fund manager in the US. And then we also have that state by state guide on exempt reporting advisors, which covers, I think, 40-ish out of the 50 states. And those two resources collectively should give you an asynchronous picture of whether you can start a fund. The rest, if you think you can raise and this is something you're seriously thinking about doing, then definitely reach out and we're happy to talk more on a one-on-one basis to see if we can make it happen. Quickly, just Alex, I saw your last question. Yeah, I think that's right. I think it's the strategy and the fundraising, and which makes sense, right? Like, it's not really about your service providers that's going to be the issue. There are bad service providers out there, but that's kind of a separate topic. So cool. I know we're at time here, Michael. Anything final on your side that you want to wrap up with?
Yeah, I'm just going to share. I also shared the link to Repool and Composer in the chat, and I will just share a quick blurb on Composer business accounts. So for Composer business accounts, we're really your all-in-one quant trading platform built for sophisticated investors, family offices, and emerging fund managers. It offers a complete end-to-end solution, empowering to really build, test, and execute fully customizable and automated trading strategies with no-code tools. And for Composer business accounts, we're currently offering a free consultation. So if you'd like to book a consultation, feel free to sign up in the link below there. Um, and yeah, no, it's been great. Kevin, thank you so much for taking the time to share your insights and join this webinar with us. Um, and yeah, people in the chat and people listening, stay tuned for a recording that will be shared with you after this event is done. So great. Any last things from you, Kevin, before we end?
No, not at all. I would just say we have clients who are on Composer. So if this is already the platform you're using and that's where you want to run the strategy, that's great. I think, again, the other common primes for hedge funds are generally just basically interactive brokers. Maybe a quick note, like for those of you trading on retail platforms like Schwab or Fidelity, actually, surprisingly, those are generally not options for emerging managers, either because they have on the institutional side a very large minimum, like in case of Fidelity, or actually they just don't have an institutional prime, like in the case of Schwab. So getting comfortable trading on a platform that you would actually run the fund on is probably the final parting piece of advice I would give. If you're really tied to some platform and then they don't service hedge funds, then that's just going to be pain for you. So just a quick heads up there. Otherwise, thank you everyone for the time. I hope some of this content was helpful and maybe I'll catch some of you around in the future.
Okay, awesome. Thanks so much, Kevin. Thank you. Thanks everybody for joining. See you guys in the next one.